clear change happened over the last several months, maybe the last half year, I'd say. 2021 obviously was a great year for tech. 2022, the earlier part, maybe you could still discuss, was it good? But the back end of 22, things certainly started getting tougher. And frankly, from a finance and capital markets perspective, most of 2022 already was a much tougher spot. Parts of markets were either shut down or inactive, or very low volumes were happening. That applies across both, certainly on the equity side. I mean, look at the number of IPOs that happened last year, or tech IPOs specifically. Negligible, let's say. So the big question, I guess, is what is happening this year? What does the market look like? So let's start with the equity markets, right? So on the equity side, on the IPO side, it's slowly coming back. There is a pipeline of deals that's waiting to hit the market. They're just waiting for the right conditions. So let's give it another quarter or so, but I hope and expect that volumes will pick up. As it relates to the debt markets, those markets never really shut down. In the tech space, particularly popular are so-called convertible bonds. Even at the beginning of the pandemic in early, 2020, the convertible market was like one of the very rare spots that stayed open even during the toughest of times. So clearly convert remains the preferred debt financing vehicle in the tech space. And that continues to be the case. When we had our little prep conversation, we were talking about this and joking about this, how a convertible bond salesperson will always tell you it's the right time to issue. Normally you say when you're in a higher rate environment, hey, give up a little bit of potential equity upside, but in return get a lower coupon. But when rates were down in the basement, how did you argue for a convertible bond? Well, when the coupon was literally 0% and a 50% plus conversion premium. So basically your stock price would have to be 50% higher from today's value for the investor, for that person, for them to make sense to convert the bond into equity. Even then it was attractive. And now that rates have gone back up, guess what? The traditional argument works again. So convertible just stays top of mind, in particular in the tech space. Traditional debt, you have to see the leverage market was in a tougher spot for a while. You see some activity kicking in. And traditional bank debt is a whole different story to begin with, right? Traditional bank debt, so-called pro rata debt, revolvers, term loan A's, that's a relationship play. So basically that's when we go back to the earlier point about a long-term relationship, a mutually beneficial relationship with your bank. If you have that and they know you, they should be working with you on a credit facility. And then pricing is driven by the relationship. Clearly the financial covenants will be driven by how they look at your business, but pricing definitely is relationship pricing. That market is, I'd say, always there. Just the pricing you'll get, the terms you get, of course, will vary depending on how your business is doing.